Hey guys, welcome back to Ripe for Investing, and I'm going to continue my bond series here, and what I'm going to do is I'm going to compare bonds to bond funds, look at some of the advantages and disadvantages. As I was learning how to invest, this was one of those topics that personally I found kind of confusing, bond funds at least. There's a lot to them. So let's go ahead and get into this. Basically, you're going to have an individual bond, and then you're going to have a bond fund, which is a packet or a bundle of bonds. And these can come in treasuries, corporates, municipals, and things like that. For most of this talk, I'm just going to assume treasury bonds is what we're referring to, okay? So what are some of the disadvantages of bond funds? Number one is with bond funds, you have a management fee. Number two is there's greater risk. Number three, if you're trying to live off income, your income will fluctuate with a bond fund. Number four, there is no fixed maturity date. Number five, no guarantee that you're going to get your money back. And we don't like that. So let's kind of look at these individually. So number one, with a management fee, it's just like any old ETF, right? You have a expense ratio on there and a management fee for the person that is running the fund, the whole process of buying and selling all of these bonds and so forth. So you're going to have an expense ratio, and it depends on the fund as far as how high that will be. And another thing I was going to say is I'm assuming that we're talking about non-closed-end funds, because closed-end funds have much higher expense ratios. You can go watch my closed-end fund video for some information about those. Unlike a bond fund, an individual bond, you don't really have this management fee, especially with treasuries. Now, something like a corporate bond, which I honestly don't have a lot of experience with as far as buying and selling them, I understand that you may have a commission or a markup fee as far as that goes. As far as the greater risk here, with a bond, you basically are guaranteed to get your money back plus the interest if you hold it to maturity. Now, if you sell it beforehand on the secondary market, that's a whole different story. We'll get into that more. But basically, with a bond, you can't really lose money unless, you take inflation into account, as long as you hold it to maturity. And with these bond funds, you actually can lose your money. You could have a capital loss, if you will. And that's because as interest rates rise, the price of the bond funds may go down. We've seen this with TLT. It went down over 20% over the last year. It's really taken a licking, as you may have seen. And unfortunately, I have a little bit of TLT in one of my retirement accounts there. So the price of these individual bonds, they do fluctuate just like a bond fund can do, but you're not going to notice any of that if you hold it to maturity, basically, okay? Another risk with these bond funds, unfortunately, is that the fund manager could collapse or something like that. Something bad could happen. With an individual bond, if you had a corporate bond, it could, of course, default. But if we have treasuries that we're talking about, hopefully the U.S. government doesn't default. And I won't go into that recent political kind of talk that's happening right now. And hopefully that doesn't happen. But with these bond funds, you've got a lot more risk. You've got market risk, you've got fund risk, the price that you could not get your money back, essentially. Now, this next one, your income could fluctuate. So a lot of people buy bonds because they are fixed income investments, meaning that you buy this thing and over the next year you're going to get X amount of dollars into your account, and it's going to give you, quote, income for buying that bond. Unfortunately, with a bond fund, since it's always buying and selling bonds, you don't really know the rate that you're going to be getting. The rate fluctuates, especially if they're raising interest rates like they're doing right now. Your bond fund is going down in price, but you're getting paid a higher interest rate. So you can't really predict what your income will be, whereas with an individual bond, it's very predictable, okay? And as I stated earlier, there is no guarantee that you're going to get your initial investment back with a bond fund. So with these individual bonds, you're definitely going to get your money back and the principal if it's a treasury. Now, if it's a corporate, once again, it could potentially default. What about some advantages to these bond funds? Here are a couple. It's very easy to buy and sell these things in your brokerage or your retirement accounts. Number 2, diversification. Number 3, mutual bond funds will allow you to auto reinvest. Next one, investment minimum is less with a bond fund. Okay, so let's get into this a little bit more. With a bond fund, it's very, very easy to buy and sell these things. You could go into your brokerage account tomorrow, buy one, and then sell it the next day with no problems, no waiting period or anything like that. So very easy to buy and sell. Individual bonds can be easy to buy and sell, but as some of you may know, the Treasury Direct website is not the best in the world. So sometimes it's not easy to go in there and buy and sell. And also, you may have to wait for an auction with an individual bond. And with a bond fund, you don't have to sit around waiting on, the 52-week Treasury bill that is only auctioned off only so often. So that kind of thing you don't run into with a bond fund. Next thing that's more really important is diversification. In the case that you're buying, say, a corporate bond, you're taking on a concentrated, highly risk that maybe that corporate bond could default. But if you buy a corporate bond fund, then it's going to have a basket of these corporate bonds. And even if one of them goes kapooey, you still got a bunch more there in your basket. So a lot less risk involved when you start looking at, say, corporate bonds, okay? Next one, mutual fund auto reinvest. And I've done this. I've got one bond fund in one of my retirement accounts, and it pays me like $10 a month or something, somewhere around there, $9, $10. And if I want to, I can go in there and say, take that $10 and auto reinvest. So basically just keep purchasing more and more shares, and then my income, of course, increases. So that's the cool thing about these mutual fund bond funds. Next one, investment minimum is less, okay? So once again, with these bond funds, you got $10 in your account. You could potentially buy 10, maybe partial shares of a bond mutual fund. So you don't need to have $500 to buy one. Whereas with some bonds, they may have a minimum of $500. If you're buying municipal bonds, they may have a minimum of $10,000 or something. So that is one real big advantage to these bond funds, is if you only have a small amount of money, you can go ahead and invest right away. Now, here's my disclaimer. I personally own SCHR, that's the Charles Schwab Intermediate Treasury Bond Fund, and I also own TLT that I mentioned earlier. That's the long-term government bonds. These are in my portfolio for risk management purposes, okay? I'm a little bit older than I used to be, so these are in there for risk management purposes. Now, I also own individual bonds like I-bonds. I own some 1-year treasuries, 6-month treasuries, and I think I even might have a 1-month treasury here as well. And so kind of what my personal opinion, everybody's different. I'm not a financial advisor. I'm certainly not telling you what to do. But for myself, I personally like to buy individual bonds for short-term maturities, basically. And then when we get out longer, I prefer to buy the bond funds because I don't know what the inflation rate's going to be. I don't really want to be locked into one rate, like going and buying a 10-year T-bond at an exact rate of like 3.62, and then tomorrow rates are raised and now I have a 5% or something. So I don't want that to happen. So I feel personally more comfortable with the long-term bond funds, and that's where I'm at. Anyways, please visit my website, sign up for my newsletter over there on ripeforinvesting.com. I'm going to keep putting out these bond videos because I think there is a lot of kind of confusing terms and confusing things about them. So hopefully help you on your journey on the way. All right, you guys take care.